Welcome back to the Malaysia Money Matters show. It's the 6th of March, 2025, and we've got a lot to cover today from company news like big moves from retail giants to international trade wars heating up. Let's dive right in.
Yeah, sounds good. Lots happening in the Malaysian market right now.
Absolutely. So first up, let's talk about AEON Co. They're planning a major expansion of their AEON Mall, Kinta City in Perak. It's their first outlet in the state. Opened way back in 1997. They're adding new retail lots, revamping the common areas, improving facilities. Plus, they've extended their lease with KIP REIT. It seems like a pretty serious long-term commitment to the area. What do you think about this move?
Well, it looks like a smart play by AEON to me. They're really doubling down in Perak, which, could show strong consumer confidence in the region. By upgrading the mall and extending the lease, they're not only catering to their current shoppers, but also trying to attract new ones. This could definitely have a positive impact on AEON's stock and maybe even boost KIP REIT as well.
Right. It's not just about staying competitive. It's about tapping into the growth potential of Perak. Speaking of bold moves, AirAsia is adding 14 new aircraft to its fleet this year. They're aiming for a huge 70 million passengers. That's way above industry projections. What do you think is driving this aggressive expansion? What does it mean for Capital A, which is still trying to get rid of its PN17 status?
Well, AirAsia is clearly betting on the travel rebound in the Asia-Pacific region continuing. It's a bit of a risky bet, but, if it pays off, it could really boost Capital A's revenue and help them get back some investor confidence. And remember, AirAsia X is supposed to absorb AirAsia Aviation Group soon, so this fleet expansion could be part of a bigger strategy to consolidate their operations and, position themselves for growth down the line.
It's definitely a high-stakes game, but with some big potential rewards. Now let's switch gears to the tech sector. Chemlite Innovation. A surface finishing treatment company is making its debut on the ACE market on March 26th. They're hoping to raise RM45 million to expand their facility and invest heavily in non-metal plating. They're aiming for it to be 50% of their revenue by 2026. That's a big jump from the current 14%. What do you think about their prospects?
It's a pretty ambitious target, especially in the current global economic climate. I think the success of their IPO and their ability to hit that revenue target will depend on a few things, like market demand for non-metal plating, securing new clients, and managing costs effectively. Investors should definitely keep an eye on them over the next few months.
Absolutely. Classic case of high risk, high reward. Now let's look at the financial sector. CIMB just launched their new 6-year strategic roadmap, Forward 30, and they've got some pretty big goals. Top quartile ROE, a 45% K to transfer ratio, and reduced cost of funds. They're coming off a record profit year. But do you think they can keep up this momentum?
Forward 30 is a pretty comprehensive plan. It really focuses on digitalization, regional expansion, and sustainability. CIMB's recent performance has been encouraging. But hitting those targets will require strong execution and the ability to adapt in this market that's changing so rapidly. Investors should really look for concrete evidence that they're making progress in these key areas before they get too excited.
Yeah, the proof is in the pudding, as they say. Let's move on to Magnetek Industries. They reported a slight profit increase, even though revenue dipped a bit, thanks to some good foreign exchange gains and lower raw material costs. Plus, they're paying out a higher dividend. Always good news for investors. But with the garment business being so volatile, how sustainable do you think this performance is?
That's the question, isn't it? Magnetek has definitely been resilient in navigating all this global uncertainty, but their long-term performance really depends on managing costs, diversifying their products, and adapting to those changing consumer preferences. That higher dividend is attractive. But I think investors should also look at the company's overall financial health and what their future prospects look like.
That's a great point. Speaking of stability, KJTS Group just secured a 20-year contract from KIP REIT for retrofitting operations and maintenance and chilled water supply for 7 KIP malls. That's a really long-term revenue stream, especially with all the uncertainty right now. Do you think this could be a big deal for KJTS?
This contract is a big win for KJTS, no doubt. It gives them long-term financial stability and predictable income. And it also shows they have real expertise in building management and maintenance, which could lead to more opportunities in the future. Investors are going to be watching to see if they can really deliver on this contract and use it to grow even more.
It really shows what they're capable of and could set them up for even more success in the future. Now let's talk about 2 companies that are trying to strengthen their finances. Kerjaya Prospect Property is proposing a rights issue to raise RM325 million, mostly to fund property projects and pay down debt. And Visione Holdings is proposing a share capital reduction to deal with accumulated losses. What do you think about these moves?
Both companies are taking steps to try and fix their financial challenges. But we'll have to wait and see how effective they are. Kerjai Prospects' rights issue could give them the money they need to go after growth opportunities, but it also adds to their debt. Investors need to think about whether they can manage that debt and get good returns on these new projects.
And what about Visioni's capital reduction?
Well, it's more of an accounting move, trying to clean up their balance sheet. It won't have a direct impact on shareholders, but it could make investors feel better about them and maybe even bump up their stock price. But it's important to remember this doesn't really address the root of the problem, the operational issues that led to those losses in the first place.
So both moves are worth watching, but we need to analyze them carefully before jumping to any conclusions. Now let's turn our attention to the international scene.
Well, the big story is definitely this escalating trade war between the U.S. and China. Trump's tariffs on imports from China, Mexico, and Canada are really shaking up the global economy. And, Malaysia is feeling it too. The FBM KLCI is down 4.6% this year, and the energy index has been hit especially hard. It's down to a 2-year low.
Yeah, it's a lot to take in. This trade war is definitely creating uncertainty for Malaysian companies, especially those that rely a lot on exports. But it sounds like some companies are finding a silver lining, right?
Right, like PPB Group, they're big in the grains and agribusiness, and they're actually expecting lower grain costs because of this trade war. That could mean higher profit margins if they can really capitalize on it.
So there could be benefits for some companies, but what about the overall impact on Malaysia's economy?
It's kind of a mixed bag. On the one hand, the trade war could mess up supply chains and make investors nervous. But on the other hand, it could create new opportunities for Malaysian companies. In sectors like semiconductors, for example, the Prime Minister just announced this partnership with the UK's ARM Holdings. They're a leader in chip design. That collaboration could attract foreign investment and really give Malaysia's tech sector a boost.
It's interesting how a global event like this can create both challenges and opportunities. It really shows how important it is to be flexible and able to adapt in today's world. Speaking of adapting, Bank Negara Malaysia's move to put a cap on medical insurance premium increases has made some insurance providers like Allianz Malaysia a little worried. RHB Research even downgraded their stock because of it. How do you see this playing out?
Well, the central bank is trying to protect consumers from those rising healthcare costs, but it could definitely hurt the profits of insurance companies. Allianz and others will need to find ways to deal with it. Maybe by becoming more efficient or focusing on products with higher margins. It'll be interesting to see how they change their strategies in response to this new regulation.
Yeah, definitely something to keep an eye on. Let's switch gears now to the construction sector. It's been showing some signs of recovery globally. Knight Frank reported strong growth in commercial real estate investment in 2024, and Malaysia is benefiting from that. High net worth individuals are really driving the market, especially in the office and industrial sectors. This seems like good news for local players like Sunway Construction Group. They just landed a RM 1.5 billion apart contract for a big transit-oriented development project in Johor.
Absolutely. This global recovery is really positive for Malaysian construction companies, but there's still some challenges to think about. The U.S. has these new regulations on AI technology, and then there's the rise of China's DeepSeek AI assistant. They're both creating some uncertainty in the market. These advancements could change traditional construction methods and make things more competitive.
So while the overall outlook is good, there are still some things to watch out for. Now, before we get to our listener mailbag, I wanted to touch on a few other developments.
Yeah, good idea. A few things stood out to me, too.
First, the Bank of Japan seems pretty set on sticking with their plan to raise interest rates, even with all the global uncertainty.
Yeah, their deputy governor, Shinichi Uchida, pretty much confirmed that. They think Japan is on track to hit that 2% inflation target, and that raising rates will eventually lead to a more stable economy.
So they're in it for the long haul, even if it means dealing with some short-term ups and downs. Interesting. Another thing that caught my eye is Malaysia's potential in this thorium nuclear technology.
Oh yeah, that's a really exciting area with a lot of potential. Minister Chang Li-Kang mentioned that Malaysia is looking at working with China and India. They're the leaders in using thorium as a nuclear fuel.
Thorium is more abundant than uranium, and it produces less radioactive waste. So it's considered a next-generation nuclear fuel. If Malaysia can get in on this, it could be a huge benefit in the long run.
Absolutely a sector to watch. Now, shifting to manufacturing, the Federation of Malaysian Manufacturers, or FMM, released a survey, and it had some interesting insights into the challenges and opportunities facing the industry.
What were some of the key takeaways?
Well, it highlighted concerns about rising costs. Almost half of manufacturers expect their expenses to go up by 5% to 10% this year.
What's causing that?
The higher minimum wage and those mandatory wage costs that were implemented this year are a big part of it. But even with these cost pressures, manufacturers are still cautiously optimistic about business conditions and growth in 2025.
So they're adjusting to the new landscape and trying to be more efficient and productive. It's good to see that resilience.
Definitely. Now back to the energy sector. Like we talked about earlier, the energy index hit a 2-year low today. Because of that drop in Brent crude oil prices and OPEC Plus deciding to increase oil output. But some analysts think this sell-off could be a good buying opportunity for some oil and gas stocks.
Oh, really? Which companies are they talking about?
They're looking at companies like Dayang Enterprise Holdings and Keyfield International. They've got a history of steady earnings, and they offer pretty good dividend yields. They could be good options for investors who want to get into the energy sector without taking too much risk.
Useful info for our listeners. Before we wrap up this segment, I wanted to touch on 2 more things. PNB Investment announced an 11.4 cent per unit income distribution for their Sharia Growth Fund. Great news for investors looking for Sharia-compliant options. And then there's Country Garden Holdings, a big Chinese property developer. They missed their own deadline for reaching a deal on their debt restructuring plan.
Yeah, that's not a good sign for Country Garden. They've been struggling with low sales and pressure from creditors. Missing this deadline just adds to the uncertainty and could have a ripple effect on the whole Chinese property market. It's already facing some serious challenges.
Definitely something to watch closely. So as we finish up this deep dive into the Malaysian market, what are some of the biggest takeaways for our listeners?
A few things really stand out. First, the global landscape is always changing, and things like the US-China trade war create both challenges and opportunities. Malaysian companies and investors need to stay informed, be flexible, and adapt quickly to deal with these changes.
Being able to adapt is so important. What about specific sectors?
Some sectors like construction and technology are showing strong signs of growth, thanks to global trends and government support. But it's important to remember that all investments have risks. It's crucial to do your research and understand what you're getting into before you make any decisions.
Great advice. Don't just jump in without thinking. Informed decisions are the best decisions. Anything else you want to add before we wrap up?
Just that knowledge is power. Staying up to date on market trends, economic news, and what companies are doing is so important for making good investment decisions. Resources like the Malaysia Money Matters podcast are really valuable for staying ahead of the game.
Couldn't agree more. We're all about giving our listeners the insights and information they need to understand the Malaysian market. So make sure to subscribe to the Malaysia Money Matters podcast for regular updates and in-depth analysis. Until next time, happy investing. Hey there, thanks for tuning in. If you would like a deeper dive into all the investment opportunities from today's news, subscribe to my newsletter at moneymatters.substack.com. I will be sharing a deeper analysis of the key investment opportunities from today's news, including what makes these opportunities stand out and how they fit into the broader market trends. By subscribing to the Malaysia Money Matters newsletter, you will also get exclusive insights on my watch list and portfolio and fundamental reports on Malaysian listed companies.